So the market's in a bit of a tug of war right now. We're going to dive into the details. So stick with me. My name is Brian Cannon, and welcome to Markets in 5. So we've talked a lot about this recently, but the 10-year Treasury yield is having an effect on the market. And so as you can see here in the green, the Treasury yield has risen dramatically. And it's not the fact that the Treasury yield is rising, it's the fact that the Treasury yield is rising so rapidly. And that's what the market's trying to digest. So we're having this pull, this push and this pull, this kind of this tug of war as to what's working in the market, what's not working in the market. And as that Treasury yield has risen, of course, bond prices have dropped. And it also is putting pressure on a lot of the growth related stocks. And so you've seen value really start to begin to take over from a market leadership standpoint. But that's a big part of what's creating some adversity here in the market as of late. So in this chart, it does break down the growth and the value. So again, these are some charts that I'm recycling that we've been through, but it's just important because it's what we're really in the throes of right now, trying to kind of discover which of the tug of war is going to win from the standpoint of growth or value and small cap and large cap. And there's a lot of things at play right now. So as you can see here, and I am a big mean reversion guy. I do feel like anything that gets too far stretched to the upside or too far stretched to the downside eventually comes back to the mean. And growth is, as relative to value, has definitely been stretched to the upside. And so you're seeing this, it's like a rubber band that pulls and eventually you let it go and it snaps back into place. And you're seeing that right now with the growth. So it's definitely broken down relative to value. It doesn't mean that it's dead or that it's gone. It just means you need to be a little bit more selective and you need to find those growth plays that are working out well. Now we do have a little bit of a support here in this green line here. You'll see. And so the question will be, will this hold and will the growth come back into play? I would say if the Treasury yield continues to rise at the rate in which it is rising, I would say that you're going to see value continue to outperform in the short term. So that's what we're watching. That's what we'll continue to monitor as we're choosing investments for our portfolio. Again, as growth outperformed, so did the Nasdaq. The Nasdaq has a lot more growth-oriented stocks in it. And so as this has kind of started to settle down, and now we're in this sideways trend mode here, and it did break down, but it seems to have come back up and broken back through that resistance. So this is something we're watching very closely. Is the Nasdaq going to be able to build on this small kind of reversal they've had here recently, or is it going to break down and continue its either sideways motion or potentially even break down? And that's something we're watching very closely. So the last chart here is really just, let's just get back to the basics. Sometimes you can get so caught up in all the charts and all of the various, what's this going to do and what's that going to do. At the end of the day, we just want to watch the S&P. We want to make sure, are we technically trending up? Are we holding supports? Is it heading the right direction, or are things breaking down? And as it stands right now, everything looks fine. And actually, if you go back and you look at the 10-year Treasury's effect, the rise of the 10-year Treasury to the S&P 500 over time, it generally is one of these deals where it just starts to reverse and starts to head up, is where there's a lot of kind of confusion in the market and a lot of push and pull and tug of war. And then once it kind of slows its upward pace and it continues trending upwards, the market can digest rising rates, especially being so low, historically speaking, So I'm not really concerned about the rates long term. Now, if they get back up to 4 or 5%, yeah. watch out. But we're not anywhere near that. Historically speaking, we're still very low. We're watching this closely. We're watching a lot of different relationships to determine, do we want to have risk on or do we want to have risk off? And at the end of the day, it doesn't matter which direction the market goes. We're going to do our best to protect, but essentially if things start to roll over, we're just going to sidestep it. We're going to put it in cash and let the market do what it's going to do. So if we can be of assistance to you in any way, or if you've got any further questions that we can help you out on, by all means, give us a shout. It's what we're here for. So thanks for joining me. Again, my name is Brian Cannon. We'll see you on the next Markets in 5.